Car insurance is an integral part of the American driving experience, serving as a safeguard against unforeseen accidents and ensuring that drivers, passengers, and vehicles are protected. In the United States, where an estimated 276.1 million vehicles were registered in 2020, car insurance is a multi-billion-dollar industry, reflecting the sheer scale of its importance. This lengthy paragraph will delve into various facets of car insurance in the U.S., from its types and coverage to its regulations, pricing factors, and the role of technology in shaping the future of this industry. At its core, car insurance in the United States can be categorized into several distinct types, each designed to cater to different needs and circumstances. The most common among these are liability insurance, which is often mandatory in most states, and comprehensive coverage, which protects against damage not caused by collisions. Collision coverage, on the other hand, deals specifically with accidents involving other vehicles, while personal injury protection (PIP) insurance provides coverage for medical expenses related to accidents. Furthermore, uninsured or underinsured motorist coverage helps in scenarios where the at-fault party lacks adequate insurance. One of the most vital aspects of car insurance is liability coverage, which comes in two forms: bodily injury liability and property damage liability. Bodily injury liability covers medical expenses and legal fees if the policyholder is found at fault in an accident that injures another party. Property damage liability, as the name suggests, covers the cost of property repairs, including other vehicles, structures, or objects, in an accident where the policyholder is responsible. These two forms of liability coverage help ensure that those affected by accidents have access to the resources they need to recover, reducing the financial burden on the at-fault driver. Car insurance, as a mandatory requirement in nearly all U.S. states, varies in its minimum coverage limits, which reflect the minimum amount of insurance a driver must carry. The liability coverage limits for bodily injury and property damage often differ from state to state, with some requiring a more comprehensive minimum coverage than others. For instance, California mandates a minimum liability coverage of $15,000 for bodily injury per person, $30,000 for bodily injury per accident, and $5,000 for property damage, while Alaska has higher minimums, requiring drivers to carry at least $50,000 for bodily injury per person, $100,000 for bodily injury per accident, and $25,000 for property damage. Comprehensive coverage and collision coverage, which are not mandatory in most states, provide added protection for policyholders and their vehicles. Comprehensive coverage safeguards against damages caused by factors other than collisions, such as theft, vandalism, natural disasters, or falling objects. Collision coverage, on the other hand, covers the repair or replacement of the policyholder's vehicle in the event of a collision, regardless of fault. These coverages are often valuable for those with newer or more valuable vehicles, as they offer a level of financial security beyond what liability coverage provides. Beyond these core coverage types, car insurance in the U.S. often includes additional options and features such as uninsured and underinsured motorist coverage, personal injury protection (PIP), medical payments coverage, and rental car reimbursement. Uninsured and underinsured motorist coverage comes to the rescue when an accident occurs with an at-fault party who doesn't have insurance or doesn't have enough coverage. PIP insurance, on the other hand, is often known as no-fault insurance because it provides coverage for medical expenses and other damages, regardless of who is responsible for the accident. Medical payments coverage focuses solely on medical costs, while rental car reimbursement assists with the expenses of renting a vehicle while the policyholder's car is undergoing repairs. When it comes to pricing car insurance in the United States, there are numerous factors at play, making it a complex and often perplexing process. Insurance companies consider a driver's age, gender, marital status, driving record, credit history, and the make and model of the insured vehicle. Younger drivers, especially teenagers, often face higher premiums due to their lack of experience and higher accident rates, while married individuals typically receive lower rates due to the perceived stability of a family. A clean driving record, with no history of accidents or traffic violations, can significantly lower premiums, as can a solid credit score, as insurance companies tend to correlate good financial management with responsible driving. In addition to personal factors, the location of the insured vehicle plays a crucial role in pricing. Urban areas with higher population densities and more traffic often come with increased insurance costs due to higher accident rates. Vehicle type and age also influence premiums. Newer and more expensive cars often result in higher insurance rates due to the cost of repairs or replacements. Finally, the coverage amounts and deductibles chosen by the policyholder directly affect premium costs, as more comprehensive coverage and lower deductibles typically lead to higher premiums. Car insurance providers in the United States operate within a regulatory framework that differs from state to state. While each state has the authority to establish its own insurance laws and regulations, there is a common thread among them that aims to protect the interests of consumers. Many states have established insurance departments or commissions, responsible for regulating insurance providers and ensuring they adhere to fair and ethical practices. These departments often oversee the approval of insurance rates and forms, monitor the financial stability of insurance companies, and assist consumers in resolving disputes with insurers. The National Association of Insurance Commissioners (NAIC) plays a significant role in setting guidelines and best practices for state insurance regulations. The NAIC helps to coordinate the efforts of state insurance departments and ensures that insurance companies operate ethically and transparently. Moreover, the organization facilitates collaboration among state regulators, enabling the creation of uniform standards and regulations in the insurance industry, including car insurance. The role of technology in the car insurance industry is rapidly evolving, bringing about substantial changes in how insurance is priced, purchased, and claimed. Telematics, which involves using devices or smartphone apps to monitor a driver's behavior, has gained traction in recent years. Insurance companies offer usage-based insurance programs that provide personalized rates based on individual driving habits. These programs track factors like speed, braking, and mileage, rewarding safe drivers with lower premiums and providing a path to improvement for those with riskier driving behaviors. Furthermore, the advent of self-driving vehicles, also known as autonomous cars, poses new challenges and opportunities for the car insurance industry. While these vehicles are expected to reduce accidents significantly due to their advanced safety features, questions rise about liability when an accident does occur. Insurance providers are adapting by offering new products designed for self-driving cars, considering factors like the manufacturer's liability and the interaction between autonomous and manually driven vehicles. Another notable development is the emergence of insurtech companies, which leverage technology and data analytics to streamline the insurance process and offer more personalized policies. These companies often simplify the application and claims processes, making it easier for consumers to access insurance and file claims. Moreover, the rise of online insurance marketplaces allows consumers to compare quotes from multiple providers, fostering competition and enabling more informed decision-making. In recent years, the ongoing battle against distracted driving has prompted insurance companies to consider the role of smartphones in accidents. To address this issue, some insurers offer discounts to policyholders who use apps that block incoming calls and texts while driving or that monitor and encourage safe phone usage. Car insurance companies have also adapted to the gig economy, recognizing that the traditional model of car insurance may not fit the needs of rideshare drivers such as those working for Uber or Lyft. As a result, some insurance providers now offer specialized rideshare insurance policies that bridge the gap between personal and commercial use of vehicles. It's worth noting that car insurance fraud remains a persistent issue in the United States, contributing to higher premiums for honest policyholders. Fraudulent activities include staged accidents, fake injuries, and falsified claims. In response, insurance companies employ special investigation units sized to identify and combat fraud. State governments have also implemented anti-fraud laws and regulations, and there are consequences for individuals caught committing insurance fraud, including legal penalties. The future of car insurance in the United States holds exciting possibilities and challenges. Advancements in technology, such as the continued development of self-driving vehicles, telematics, and data analytics, will reshape the industry's landscape. Consumers can anticipate more personalized and usage-based policies that better align with their driving habits and risk profiles. Furthermore, the ongoing battle against distracted driving and the mitigation of car insurance fraud will be essential areas of focus for the industry. As technology and data-driven insights continue to influence car insurance, it's likely that the industry will become more transparent and competitive. Insurance providers will explore innovative ways to serve consumers, ensuring they have access to the right coverage at the right price. The regulatory landscape will adapt to accommodate these changes, focusing on consumer protection, fair practices, and the establishment of clear rules for new and emerging technologies in the car insurance sector. In conclusion, car insurance is a fundamental aspect of the American driving experience, designed to protect individuals, their vehicles, and their financial well-being. In the United States, a complex system of regulations, coverage types, pricing factors, and emerging technologies shapes the car insurance industry. Drivers are encouraged to select the appropriate coverage to suit their needs, maintain safe driving habits, and stay informed about evolving industry trends. The ongoing development of technology and regulatory changes will continue to mold the car insurance industry, aiming to provide consumers with more personalized and accessible coverage options, while combating fraud and ensuring road safety. The dynamic nature of the car insurance industry ensures that it will remain a topic of significance and interest for individuals, lawmakers, and industry professionals alike. Understanding the intricacies of car insurance in the United States empowers consumers to make informed choices and promote safer and more responsible driving habits, ultimately contributing to the well-being of all road users and the efficient functioning of this critical sector of the economy.